Welcome into EP Wealth Advisors Informed Investor Market Update. I'm Rob Black. Joining me today, Managing Director of Investments at EP Wealth Advisors, Adam Phillips. We have put through a whole month of 2025. I want to start with a little bit of a report card, as I do every week on these event updates. The Dow Jones Industrial Average is up 4.7% for the year. It's the winner, not necessarily the same rank that we had last year. Coming in number 2 so far. Also, a little bit of a flip from last year, up 3.8% is the S&P Mid Cap 400. The S&P 500 up 2.7%. Big winner last year, laggard this year, even though 2.7% is a pretty good number. The Russell 2000 small cap stocks up 2.6% year to date. And the NASDAQ, last year's big winner, is just up 1.6%, trailing again the Dow Jones Industrial Average, ultimately in 5th place. I don't like making it into a pony show race, but let's make it into a pony show race for examples of talking and figuring out analogies and telling stories. Adam, any thoughts on the year-to-date numbers?
Look, my only thought is that that's no matter what you're looking at, which horse you're looking at here in the race, that those are all pretty good returns for just 1 month. And let's
Right.
think about everything that we've had to endure so far over the last few weeks. We've had a presidential inauguration. We had the wildfires in LA. We had DeepSeek this time last week when we were recording, which dragged that Nasdaq down by a few percent. Most recently, we have the tariffs to contend with. So pretty solid numbers, all things considered. And we always say, the stock market climbs a wall of worry. There's already been plenty of bricks added to that wall of worry, but so far so good.
Well said. Now, let me ask you one of those statistical questions for you. Historically, the stock market does as January does. So January was positive for the month in all 5 of those indices. There's an 89%, not probability, but historical rate of an up year, with the average up year being 19%. Do you buy into as January goes, so goes the stock market? Because it sets a tone. I don't want to put words in your mouth. Don't want to put words in your mouth. What's your thoughts?
Look, the history suggests that it does.
Okay.
I think that has a better track record than that adage, sell in May and go away.
Okay.
Um, that being said, every year is different, right? Past performance is no guarantee. So even though I would love for January, based on the numbers that we've seen, to set the tone for the rest of the year, let's just acknowledge the fact that we are coming off 2 very strong years for equity market returns, in which there was pretty, I'd say, relatively little downside volatility. We saw back-to-back years of 20% plus gains in the S&P 500. And we know that we are just in a very uncertain environment. Valuations are a lot higher today than they have been in recent years. And so there's some things that we need to grapple with as investors. So I think that it bodes well, but I certainly wouldn't look at only that.
I cooked a Sunday night dinner for my family last night, and I was a little worried. I was a little anxious because the Trump tariffs had been announced over the weekend. By Trump tariffs, I'm talking about one of his campaign promises was to make America great again by getting other countries to even out the trade balance. Canada and Mexico, who have been allies of the United States for many, many years, big economic trade partners, our biggest, they get 25% tariffs. Canada only 10% on the oil, but still 25% across the board otherwise. And China gets a 10% tariff over the weekend. We came into Monday with a lot of anxiety, Adam. Help me with the anxiety and tell me where we are.
Well, look, the markets opened. They were pretty deep in the red, and we saw that in the futures market over the weekend. We knew this pain was coming. Now, shortly, not too long after trading began, we saw a release breaking news that the president of Mexico and Donald Trump they had a call. I guess it was successful. They agreed to postpone tariffs for a month to see what happens in negotiations in the coming weeks. So that's good. What we've seen is that the market has it's gained a little bit back here. It's still in the red a little bit, but certainly not to the extent that it was. There's another call scheduled with Canada and Canadian officials in a few hours, so maybe we'll see a postponement there as well. So by the time viewers are actually watching this video, we might see we might see some progress. But I think it's just a reminder that the status quo that we've enjoyed over the last couple of years. I mean, all the norms are kind of out the window, and it's not all bad. And I know that there are many who are watching this that are supportive of President Trump and his policies, and I do think that some of them are good, are good for risk assets, are good for the economy. Now, as an investor, though, I look at some of this and I say, okay, just means that I need to deal with that additional layer of uncertainty that this creates, and the fact that this creates additional volatility. Just in the last few hours, we've kind of been hit with this whiplash, as we've seen the market give up a lot. The market was down about 2%. It's now down about 0.4%. If you look at if you just look at the Dow, which is the first one that my eyes went to on my screen here. Now, I think it's just a reminder that we are living headline to headline, and I think investors are going to watch and trade on these moves, because the range of outcomes are so wide, they are so broad, and depending on which way things kind of play out, it has very different impact on not just trade policy and the economy, but the inflationary outlook and what that means for monetary policy, i.e., the Fed going forward. So there's a lot of implications here, and I think that's why investors are really hanging on every moment, on every headline that comes out. For our clients, for our listeners, I think it's really, really important not to get too bogged down in the noise. You're going to see the market respond, and we are going to watch this because we have to. And my hope is that listeners are able to kind of take a step back and go and enjoy themselves, knowing that we are watching for them. The reality is that that you have your financial plan. You've been working with your advisors, and that financial plan has accounted for these interim bouts of volatility. If we do see this turn into something more sinister, that's what the financial plan is there for, and you could ride out these times. You shouldn't get too focused or bogged down by the noise that's going to play out in the markets. This is just, it comes with the territory of investing, but I think it's really important just to maintain that long-term perspective.
Over the weekend, I was speaking with one of the clients of EP Wealth and at a speaking event, and he said, "I haven't watched CNBC in 2 years since I became a client. Go live your life. EP's doing the work on the tariffs for you. But there's a lot with the tariffs. Like cars could cost $3,000 more. Avocado toast could go up. 80% of avocados come from Mexico, and there's like investments in Chipotle out in the world. So there's a lot going on, and I promise you, we're staying on top of this. Let's switch back to what you were just saying. The Fed meeting last week, Trump last week said, I think they should have lowered rates. This week, over the weekend, he's already said no. It was a good thing that they didn't. I'm a little confused by Trump and tariffs and the Federal Reserve, and how the three live together. What are your thoughts?
The Fed's in a tough spot. They were in a tough spot even before tariffs came into the picture. Make no mistake, they want to cut interest rates, but they don't want to jump the gun. They
Okay.
don't want to cut interest rates prematurely when inflationary pressures are still out there. We've seen disinflationary progress, meaning inflation coming down. We've seen that progress stall in recent months, and that means that even though the economy is strong, and they think that there's room to lighten up on interest rates, what they don't want to do is cut interest rates and end up providing a little bit of a boost, a monetary boost to the economy that might reignite inflation. So that was kind of the state of play before tariffs were on the table. Last week they met and they said, no surprise, they didn't cut interest rates, and they said, we're good with the economy. We'd like to see more progress on inflation. It's the labor market is holding up well. We're not in a rush to cut rates, but we plan on cutting them further at some point. And so that's kind of where the Fed is. Really no surprise in their message. It was kind of a non-event. Now, what tariffs mean for them is it just throws this additional wrench into the picture of saying, okay, well, we know, I think this is debated, but our view and the Fed's view is that tariffs are inflationary. they are inflationary. That the extent to which they are inflationary, I think, remains open to debate. I think it depends on how long these tariffs last. I think it depends on to what extent they are passed through to the end customer. Are these absorbed entirely by these companies that are importing, and they just allow that hit to their margins, to their business, or do they try to pass some of this through to their customers? So it's either effectively a corporate tax increase, but it comes in the form of a tariff, or it's an income tax increase and a tax on consumers. And so there's a couple of ways to play this, but at the end of the day, this does mean higher prices if they do last. And if it means higher prices, that means the Fed might have to hold off that much longer when it comes to cutting rates further. So I think that's really the state of play right now, and where we are is that they're in a wait and see mode here. They're probably not going to get the answers that they're waiting for uh, anytime soon, is the reality. And so I think that just means we're likely to see this period of rate volatility, equity volatility continue, because we're all just waiting to see how this plays out.
Let me push you a little deeper on this one. We saw the short term, that's the one the Fed controls. The expectations are that it's going to stay where it is longer. You just
Mhm.
explained that. But we saw the 10-year drop from about 4.6, almost 4.7 last week, now around the 4.5, 4.6 level. That could be a positive ultimately. What are your thoughts on how the bond market is handling it, the short term versus the midterm, long term differently?
Yeah, well, that's exactly right. And maybe just to take a step back, the short-term rates, as you mentioned, it is dictated by the Fed. And that's what they control, is that ultra short term, really the overnight lending rate. And the longer term rates, when we talk about the 10-year Treasury yield, for instance, that is really driven by inflation expectations,
Okay.
growth expectations. And so what we are seeing is, even though the equities are falling today, not as much as they were when trading opened, but we're seeing bond yields fall, meaning bond prices are going up for treasuries. That is that's a good thing, right? That's why you have diversification. And so I think that's really good to see bonds behaving this way. They are that safe haven asset, and I think that they're responding that way, because what tariffs mean is it's a potential growth shock to the economy, and it's a potential inflation shock. But ultimately, they're worried about higher prices and less trade, leading to perhaps lower growth, lower output by the U.S. economy. And so that's what's being priced into to treasuries right now. That's why treasury bonds are gaining, as that safe haven asset.
Note, I'm a little bit older than you, and I remember the Make America Great Again before it was Trump. It was Reagan with Buy in the USA, Made in the USA. And to say that we got out of the 80s into the 90s and 2000s, the market figures it out. That's kind of the lesson that I've learned, but I don't want to say that officially on the record. I prefer your words versus mine. Let's move on to the next topic. But I do see parallels between Reagan and Trump. Um, Earnings season. I think what I've seen so far is 79% of companies have beat earnings expectations. Again, overall health of the market, that's good news, very solid news. This week we get Alphabet, formerly known as Google. We also get Amazon. Last week we got Meta, we got Microsoft, we got Apple, we got Tesla. The big seven, the Magnificent Seven are reporting, but financials, everyone's reporting. What are your thoughts on earnings season so far?
So far, so good.
Okay.
Yeah, look, I mean, I think that there's perhaps more pressure on those mega cap tech names to perform, because those are the ones that have really been leadership for so long, and so they need to justify those higher valuations right now. And so far, so good. Just generally speaking, we're seeing a couple of them report, as you mentioned, this week. Nvidia, the biggest one, isn't until I believe the last week of February, so they have some time. But just on the whole, looking at the S&P 500 earnings season so far, it's going better than expected. We are seeing expectations kind of hang in there for the rest of the year. And so we've talked about this before, Rob, where I think the earnings season is really, really important, because you get to see how these companies performed in the most recent quarter. But I think they're even more important because you get to hear from management about what they see going forward. And that helps to set expectations for future earnings, say over the course of the year, for profit margins, and you get to hear how they are thinking about their businesses in the current landscape. And so we're hearing, no surprise, I'm sure, but we're hearing the mention of tariffs and uncertainty around interest rates and inflation. We're hearing mentions of those kind of key words just spike right now, and you could tell that this is a highly uncertain environment. And so just like we're thinking about the uncertainty, the Fed is thinking about uncertainty. It's not lost on businesses as well. They are kind of in a wait and see mode as well. So hopefully they get the clarity that they're looking for. I think what I would worry about, and what we're going to be on guard for, is if these tariffs actually come to fruition, what does that mean for future for the profit outlook in
Uh,
earnings growth and profit margins? If we start to see this dip, then that might lead to some selling pressure, or that might lead us to get a little bit more defensive, or maybe expect a little bit of a pullback in the stock market, because we have to think that after 2 years of really strong earnings growth in the S&P 500, it's now up to earnings to really justify these valuations. We need to see earnings growth, and coming into this year, we were expecting, call it 13-14% earnings growth in 2025, and so if suddenly that comes into question, that might come as a surprise to some of those stock market bulls out there. So that's what we're going to be watching going forward.
I agree with you on earnings, but also I will say there are some other stimulus ideas out there, like potential tax cuts for corporations and
Yeah.
individuals that
Yep.
might happen. So there's so much going on. I'm so glad you're doing this and not me. If Americans have jobs, they tend to spend their paycheck. If they spend their paycheck, it helps the economy, minus the argument on tariffs. If they help the economy, it helps earnings. It's kind of a virtual cycle. How about the jobs data this week? How important is that? That comes out, I believe, on Friday.
It's extremely important. Look, it's the other part of the Fed's mandate is to maintain stable and full employment. And so far so good. The unemployment rate is at 4.1% currently. So it's trended a little bit higher in recent months, but it's still, all things considered, it's relatively low. We're still adding jobs every month. The expectation for this month, or excuse me, for the month of January, is that the economy added, let's say, around 170,000 jobs. That's not our estimate. That's really the average that is posted on Bloomberg for economists of what they're expecting. So that's really what the market is expecting. We'll see where that number actually comes in. Um, but yeah, I mean, look, the market, the jobs market is hanging in there. If we saw signs of deterioration, that that starts to bring these fears of stagflation into the picture. And what that means is the economy is weakening, but inflation is still a problem. That makes a very hard environment for the Fed to manage, right? So that's what we really want to avoid. And so we are hoping that the stock market, excuse me, that the jobs market continues to remain healthy, that we don't see it shoot a lot higher, but just kind of maintains this slow and steady pace that we've seen. And I think that's really the best case scenario looking at Friday's upcoming report.
The voice of calm and reason when I'm feeling a little anxiety. Many Americans are, especially don't know what tariffs are. I want to remind everyone we record this episode on Monday morning. It gets distributed typically on Tuesday. It's meant for a lot of long-term information, but sometimes it gets dated pretty quickly because of headline news. Also, I want to remind people, if you're feeling anxious, it's always a good time to reach out to your wealth advisory team. Talk money, talk questions, talk fears, talk your goals. It's always a good time to communicate because we're staying on top of this for you. I'm Rob Black for EP Wealth Advisors Informed Investor Market Update. He is Adam Phillips, the Managing Director of Investments at EP Wealth Advisory.